Hello, Jeff Green here again with another market update for the Arizona real estate market. It's a little chilly in my house this morning, so I've got a sweater on, so please excuse my sweater. It's getting cooler and I haven't turned the heat on yet. So these are the topics we're going to talk about today. We're going to go through the crashing indicators analysis. I did a presentation on this last year. I'm going to go into this with a little bit more detail on what you need to know and why you might hear some scary headlines in the future here. We're going to take a look at listings under contract that flattened in the last few weeks after steady drop. So we might be flattening out here a little bit. We're going to talk a little bit about interest rates. There was a big good news moment in the last month from the Fed. It really hasn't changed the overall year to year, but we're going to look at the numbers and see sort of why I think late spring to early summer next year might be the time that we see some stabilization or reduction in interest rates. We're going to look at seasonal trends for the Arizona real estate market and how the increased interest rates really made the end of the year a lot worse than it is normally. We're going to take a look at the overall supply and demand balance, and then I'll just give you one slide of contact information and online resource links. So let's get into the first slide. So these are, let me move my face out of the way here. So I put together a quick chart. These are major indicators of what I call a crashing market. And I usually, or most people, usually only look at the foreclosure sale date. That's the planned foreclosures. But the process starts, 3 or 4 or 6 months earlier. What really kicks off the process is mortgage payers becoming behind on payments. When you don't make your payment, you get a letter for the first month, and then the second month you might get another really nasty letter, and then the third month you might get a phone call or something like that. But this process usually takes 30 to 60 days to sort of catch up with delinquent mortgages. And then usually what happens is the bank or the beneficiary in Arizona goes through what's called what I would call loan repair negotiations. Lots of banks have different names for it, but what they try and do is help owners stay in their house. Really, they don't want to take your house. They want to make sure that they get what the note says they should get. But of course, once you go into this sort of situation, you got attorney's fees and bank fees, late payment fees, and all that sort of stuff. So this is another 30, 60-day period before the bank finally gives up and says, you know what, we're going to sell your house and try and get our money back that way. In Arizona, you don't need to go to court. This is a deed of trust state. In other words, when an owner buys a house, they sign a deed of trust to a trustee that has the right to foreclose without going into a judicial, sort of in front of a judge type action, which takes even longer. So then the third step is they establish a foreclosure sale date. In other words, the trustee says, this is where we're going to sell your house and move you out. That's kind of an ugly situation. But that takes usually another 60 to 90 days before they establish that date. And then, of course, if nothing happens between this action and this action, like a bankruptcy can stall the whole process. So that's the foreclosure date at the courthouse, and the successful buyer of the property gets a trustee deed, which is recorded. And then if the house is not empty, then the new owner needs to make the house vacant. You probably could guess what that means. So when you look at this, you got 30 to 60 days here, 30 to 60 days here, 60 to 90 days here. And these are estimates, right? All beneficiaries or banks are different. But even if you take the shortest time, let's say, well, 1 month there, 1 month there, and 2 months there, that's 4 months before you even get, I'm sorry, 2 months before you even, no, I was right. So you got 4 months before even a foreclosure sale date is established. That's the earliest. And if you add up the longer times, 90 days, 60 days, 60 days, it can be a long time before it starts showing up in the foreclosure sale date, which is what most realtors look at. So we're going to take a look at these earlier times and see what's going on in Arizona right now. So this is the Federal Reserve Economic Data website. You can dial this up on your own. You can get this in excruciating detail. But this is the delinquency rate on single-family mortgages. And this data, if you want to go back, I think to, I don't know, I would say the 1990s. I think it goes back 20 or 30 years. Anyway, I just kept it from 2004, and you can see clearly what happened in the 2006, 2008 time period. delinquency rates went through the roof, right? They went to 2.5% of all mortgages up to over 10%. I think there was 11 or something percent. And then slowly, as the properties were sold and people purchased them, and loan qualification criteria was tightened. So it was harder to buy a house, harder to buy a house, harder to buy a house. So where are we today? At 2022, at the last date, I think this is October's date, October's map, we're right at about a little bit less than 2.5% of all mortgage in delinquencies. That's not a big number. Most market experts figure some if you're down below 2.5 or 2%, that's what they would consider stable or average or normal, or however you want to term it. So look back here, we were down below the 2.5% before the 2008 crash. And then we've slowly been declining, so we're now sort of in the same location. I don't see any uptick. There was a little uptick here in 2020. That was the COVID response, and no wonder. People couldn't work, people couldn't pay their bills. And as a matter of fact, even though there were delinquencies increasing this time period, the foreclosure process was put on hold by the federal government, if you remember that. So once we're through that, let's just call it a mess, right? It started coming back down again because of the increased criteria on qualification for a loan. So the first indication is this: delinquency rate on single family residential mortgages is not increasing, and it's not at an elevated level. So that's fact number one. Now let's go look at another chart. Now we looked at this chart last week. These lines go back 2000 to 2016. So you can see in this time period, 2016, 17, 18, and 19 is up here. We're at an elevated level for foreclosures pending. That's the second step in the chart that I showed you. If you look at 2022, we're still at this very low level. Now, the media is going to start focusing on this because what's somebody going to say? Well, when we get to January here, you can look at January from last year and you see this low point, right? So let's say that's 600 and we're now at, I don't know, what is that, 900? So somebody, I'm sure will happen, some media story will come out in the January time period, which is August here, and they'll say mortgage or foreclosures pending jumped, I don't know, 30, 40% since last January. But just be aware of that. The media likes to take statistics really out of context and make a big scary story about it. So that's one observation I have from this chart. Now, if we take a look at a longer time period, right? Remember, we're down here in the, what is that, 900, about 900 foreclosures pending. Not a huge amount at all. Okay, so that line is down here, buried in this morass of stuff from 2022 to 2021 and so on, right? These are the earlier years, 2008, 9, 10, 11. This is 11, I think this is 10, I think this is 9, and this is 8. So you can see quite clearly. We looked at this chart last week, so I'm not going to spend a lot of time on it. Until that foreclosure pending rate gets above this mess down in here, I'm not the slightest bit worried about it. And remember that this chart doesn't indicate that's going to happen anytime soon, even in the next, go back to this chart, 60 days, 90 days. So this is an early warning chart. There's nothing going on here, and there's nothing to be scared about here. So just be aware of the headlines. Foreclosures are not in trouble, and delinquencies are not in trouble at the present time. As a matter of fact, those are very low numbers. So be aware of that when you see media stories. Okay, let's look at the number of trustee sales by month. This is the actual result of that whole process that we talked about, right? You go through the delinquencies, the negotiations, the foreclosure date, and these are sales of properties at the courthouse, which completes the foreclosure process. And you can see this goes back to 2008. These charts here are current year. So this is where we had the trouble. Everybody's familiar with that. And look at where we are today. We had this amazing drop here. Oh, you could see it's zero, but it's not quite zero. But it's so low that it's remarkable. So that's what's going on today. Trustee sales per month, and this is we'll jump right here into listings under contract. So this is the current market. Last couple of weeks we had this little drop, and we're having this little bounce back on listings under contract. So this is homes on the market that have a contract on them. right? Not closed yet, but they have a contract on them. So are we hitting a bottom here? You know, I don't know. We'll talk a little bit about seasonality here. And this is not unusual for most of the real estate, residential real estate across the United States, but specifically here in the greater Phoenix and Arizona area. Now, if you want to know what's going on in your neighborhood, your price range, your zip code, your town, just give me a shout and I will tell you exactly what's going on with listings under contract and demand and supply in your area. So let's go to the next chart here, which is the United States Consumer Price Index. And this has the attention of just about everybody I know. And last month, which is October, we had the big, let's call it a good news story on inflation rates. Now, what happens is that these yearly inflation rates, even though the inflation rate, the prices still went up, the inflation rate was calculated to go down to about 7.7%. Now that might get revised, but who knows with the government rolling these numbers up. But what's important here is that this number that you can either look at the monthly inflation rate or the yearly. Now the Federal Reserve goes by the yearly inflation rate. So what happens here? So remember this chart here, this was 9.1%. And it got to 9.1% because 12 months ago, right? 1, 2, 3, 4, well, you can count. 12 months ago, it was so low. Now, you move forward 1, 2, 3, 4, 5 months, right? And we're comparing the 12-month inflation rate to a different number. See how high this number was here, which had the effect of sending the mortgage rate, the inflation rate down a tick, although prices didn't change much. So you have to look behind the numbers a little bit. So let me sort of look forward here. Let's suppose that prices stay at the same level. You've got this situation where you're always comparing the current month to 12 months ago. So you have to compare next month to this, next month to this, next month to this. So you can see where I'm going here. Once we get past 12 of these bars at the higher cost of things, that means you're going to be comparing about 8% to about 9% or to about 8%. Now, Powell has already said that as long as CPI remains at 298, 2% annual inflation based on this measure would be reached around May, as long as these prices stay the same. So you follow what I'm saying? So from here, which is May, if prices stay the same, we're going to reach that magic 2% annual inflation because we'll be comparing today's prices to another high value. So be aware of that. And also be aware that there's a lot of evidence that mortgage rates follow inflation rates more closely than they do the federal interest rates, which affect companies. So be aware of that. And I think there's a distinct possibility, as long as prices stay about the same and nothing catastrophic happens, you know, who can predict what's going to happen? But, you know, May, June, July of next year, may see some relief, maybe some reduction in interest rates. We'll keep an eye on these as we go forward. Now, let's talk about, these are new listings per calendar month. Now, this is sort of a seasonal look at what happens in real estate in the greater Phoenix and Arizona area. So these colors are just quarters, so they don't really mean anything significant, but the months are down here. Now, you can see that October, November, December, and these go back, well, let's see, how many years did I put on here? Since 2000. You can see the last quarter, especially the last 2 months, really dipped down on activity. that's easy to understand, right? Everybody wants to have a great holiday. Nobody wants to move on Thanksgiving or Christmas and stuff. So you would have this natural tapering off of activity in the last quarter of all, you know, most years, going back to 2000 and probably earlier. So it's not a surprise or shock to me or most realtors or people who follow the market that activity has tapered off, and it has. It's slowed down considerably, especially because, you know, in this area, that's when the interest rates started increasing. So if I was to do this for 2022, we'd probably even see a faster taper off on new listings by calendar month. So this is a chart of closed sales by calendar month. So these are people who really don't want to sell because they want to do other things for the last quarter of the year. Can't really blame them for that. And these are closed sales by calendar month. So you put those two together, you still see this taper off in the third quarter. December usually has a bump. Don't ask me why that happens. That's historical evidence. But you can see that after the middle of the summer, buyers sort of taper off. And additionally, for this year, with the increase in interest rates, I'm sure this curve was a lot more steeper for this year. But here's what I'm getting at. If interest rates start declining in the May-June timeframe, the increase in the Arizona area usually starts at the beginning of the year and is higher in the March, April, May, June timeframe. So if interest rates start dropping in this time period, I'm not sure what that means as far as another price war on properties, but I don't see a big crash coming, and I see prices sort of stabilizing. So if you're interested in getting in a home, I encourage that you start the process as soon as you can. You don't have to buy, but I would encourage you to get your financing lined up, start looking at properties in areas you want to move to, because you don't want to get caught in another one of these feeding frenzies if it takes place next year. You want to marry the house, and you want to just so you want to fix the payment on the house, right? You date the rate, you marry the price on the house, and then you fix your payment for the next 30 years, unless interest rates even drop further and you can refinance and lower your payment. That's a big difference from renting, where you have no control over what you're paying from month to month, and they usually go up. Sometimes the landlord will just kick you out of the house, and then you got to move every year, and no one likes to move. So I would encourage you to start this conversation 6 months before you think you want to buy, maybe a year before you want to buy, because it takes a while to find a house. It takes a while to have all the things line up so you can get the house and that suits the lifestyle you want. So that's a little bit on closed sales by calendar month in the Phoenix area. Here's a summary on the Cromford Index, which is a sort of a summary company that I sign up for, and it really helps me in understanding the market. So this is the overall market index. I think last week this was at 89 or 90. So anything below this little yellow triangle here is considered a balanced market. We're a little bit off, a little bit on the buyer side of a balanced market. I don't think that's significant at all. It's not a buyer's market like it was in 2008, and I don't think it will be. The supply is still in the green zone, which means that we don't have a lot of sellers. So the supply is a little bit constrained, and demand certainly has fallen off due to interest rates, and also, like we just discussed, the seasonal changes in the Phoenix area. So I did put the supply index trend on here, and you can see very well that the supply has come down, which is sort of supporting of prices here. Okay, so don't be worried about prices crashing. I think you'll have 6 to 10, maybe a year's worth of notice that that's even a possibility. I'm not sure I buy that argument yet still. So this is a summary of the market. Now let me show you how you can get a hold of me. If you want to have up-to-date information, or you want to start looking for a property, or even just talking about it, give me a shout. You can stay current with developments on this channel. Subscribe to this YouTube channel here. You can sign up for newsletter subscriptions. I promise I won't ever send you any spam. And of course, there's a one-click unsubscribe, and more online resources. And this electronic contact information can be found at jeffgreenrealtor.com. So I hope this helps. I'm going to sign off. You have a wonderful day, and we'll talk to you next Monday.